Thank you very much for joining us. This is our fifth lecture on working capital. In our last lecture, we have discussed there are three different levels of working capital, and these three different levels are optimum level of working capital, over capitalizations, and over trading. We have discussed optimum level of working capital is where the working capital is sufficient, not too high, not too low. In the overcapitalization, we have discussed there is an excess working capital, while in case of over trading, we have discussed company is trying to do too much with the too little capital, means there is a shortage of working capital. Now the question arises, what is my optimum level of working capital and how we will be able to know the optimum level of working capital? Understand the optimum level of working capital and to understand the efficiency of working capital, I have summarized the discussion in this flow chart. I said there are four different ratios. First is current ratio, second is quick ratio, third is turnover ratios, and fourth is sales versus net working capital ratio. Current ratio will tell us how much are the current assets in hand as compared to the current liabilities. Quick ratio will help us to understand how much are the liquid assets in hand as compared to the current liabilities. Turnover ratios will help us to understand what is the turnover of inventory, debtors, account payables. We will be able to know the optimum level, as well as we will be able to know the efficiency of the different contents of the working capital. Sales versus net working capital ratio will help us to understand how much is the working capital available against sales. So the first of all is current ratio. As we know, current ratio is equal to current assets divided by current liabilities. If current assets are double than current liabilities, usually this is assumed in the industry that this is the optimum level of working capital. Moreover, we will compare with the industry as well to know the optimum level of working capital and to know the efficiency of the working capital. Third thing is companies needs to compare the results with the historic results to know the efficiency of the working capital. In the same way, quick ratio, the difference between current ratio and quick ratio is difference due to the inventory. Sometimes the inventory turnover is very slow. When the inventory turnover is very slow, inventory will not be converted into the liquid assets quickly. So we are removing inventory out of the current assets and we are assessing current assets less inventory divided by current liabilities. And the market standards are 1 by 1. If current assets other than inventory is equal to current liability, then we can say this is the optimum level of working capital. We can check with the industry as well to assess the optimum level of working capital. And to know the efficiency of the quick ratio, we can compare it with the historic results. Turnover ratio, we have discussed. Turnover ratio will help us to understand the efficiency, and these turnover ratio can be classified inventory turnover, debtors turnovers, and creditors turnover. Inventory turnover can further be classified into raw material turnover. Raw material turnover will help us to understand how quickly raw material is being converted into the work in process, how quickly raw material is being transferred into the work in process. Work in process turnover will help us to understand how quickly material is being converted into the finished goods. Finished goods turnover will help us to understand how quickly goods are being converted into the sales. And debtors turnover will help us to understand how quickly debtors are making the payment. In the same way, creditors turnover ratio will help us to understand how quickly we are paying to the creditors. And how to calculate these ratios. Raw material turnover is equal to average raw material divided by average annual purchases into 365. Work in process turnover is equal to average work in process divided by cost of sale into 365. Finished goods turnover is equal to average finished goods divided by cost of sales into 365. Debtors turnover are equal to average debtors divided by credit sales into 365. Creditor turnovers are equal to average creditor divided by credit purchases or cost of goods sold into 365. We have already discussed the sum of these four turnover period. Whenever we are deducting creditor turnover periods out of this, it will give me the working capital cycle. So whenever we are calculating this turnover ratio, we will compare it with the industry to know the optimum level. We will compare it with the previous years to know the efficiency of the turnover ratio. So if raw material turnover, work in process turnover, finished goods turnover, as well as debtors turnover is increasing, definitely my working capital cycle will increase. When my working capital cycle will increase, we will be required to inject more working capital. In the same way, if creditors are being paid very quickly, then working capital cycle will increase and we will be required to inject more working capital and vice versa. Sales versus net working capital ratio, as we discussed, it will help us to understand how much is the working capital available against sales. The ratio is equal to sales revenue divided by receivable plus inventory less payables, which is equal to net working capital. So sales divided by net working capital, it will help us to understand how much is the net working capital available against sale. If this ratio is going up, then we will say same working capital is available against more sales, or we can say against the same sales less amount of working capital is available. So we can say if this ratio is going up, there are chances of shortage of working capital and company will not be able to meet its current obligations. We need to take the measures accordingly. I have taken this example from ACCA book. The data has been given of 2008 and 2007. They are asking to calculate the liquidity and working capital ratios. This is the solution. In this solution, we have observed that our current ratio, this has been diluted very minutely. Quick ratio has been diluted as well. Receivable period is same. Inventory turnover has been improved. Account payable period, this is almost same. This is the alarming situation, sales versus net working capital ratio. Initially, $1 was available against $17.38 of sales. Now the same $1 is available against $28.96 of sales. So we can say initially ratio was, it was 17.38 versus 1. Now the ratio is 28.96 is equal to 1. So initially $1 was available against 17.38. Now the same dollar is available against 28.96. In other words, we can say for the same level of sales, we have lesser amount of working capital. That's why they said the ratio of sales versus net working capital indicates that the working capital has not increased in line with the sales. This may forecast future liquidity problems. Thank you very much for joining us. In our next lectures, we will discuss different techniques of working capital management. We will discuss 3 different techniques. Then we will discuss how to manage the each content like debtors, creditors, inventory, cash in the working capital cycle. Thank you very much for joining us.